Welcome to TMT channel, always striving to become better traders. In this new video, we will talk a special topic about the challenge of adapting to changing markets. A stationary time series refers to a collection of data that originates from a solitary underlying process. An uncomplicated illustration of a stationary time series would be the frequency of values resulting from the rolling of unbiased dice. While it is not possible to predict the outcome of a given roll, the frequency of the values over time remains constant and unchanged. Imagine if we were to use weighted dice and then swap them out at unpredictable intervals. In this scenario, each roll would become less predictable and the distribution of values would become random as well. Due to the use of multiple processes, the different dice, the distribution would no longer remain stationary. Financial markets, including the stock market, do not produce stable time series. This has been particularly noticeable in recent times. If we compare the market performance from the past few months to the same period in 2019, we can observe vastly different trends in price changes and volatility. Additionally, the correlations within and between stocks and sectors also fluctuate over time. The dynamic nature of markets is an undeniable reality. It's not surprising to witness constant changes in them. In fact, the variation in trading volume during different market periods is indicative of the ever-evolving participant in the marketplace. The dynamic nature of markets holds significant implications that should not be overlooked. The act of simply searching for patterns throughout various historical periods is not likely to produce significant results. Similarly, trading volatile bear markets with the same techniques and methods used in range markets or low volatile bull markets is not likely to be helpful. Rather, a more intelligent approach would involve identifying key regime variables, studying markets in those regimes, and pinpointing trading patterns that are specific to particular market conditions. This can be compared to a football team that must adapt to different opponents, field conditions, and weather conditions. A successful team will adjust to each set of circumstances, with unique game strategies that are tailored to each opponent and field conditions. Similarly, a successful trader will not adopt the same approach for all market conditions, but will adapt to each unique circumstance with the right trading strategy. It is often said that trading is a mental game, and that having the right mindset is key to achieving consistent, profitable results. However, this perspective is limited at best. Psychological disruption in trading often stem from poor trading processes rather than a flawed mindset. Traders can fall into the trap of using one set of practices and strategies that work well in a particular market environment, only to find that environment changing. When their previously successful strategies no longer produce consistent profits, traders may become frustrated or fearful. However, it is not the emotions attached to trading that are the root of the problem. Rather, the problem lies in failing to identify and adapt to changed market conditions. By understanding this fundamental issue, traders can avoid common pitfalls and achieve greater success in their trading endeavors. It's widely accepted that traders who achieve success adhere to a structured process. This would be sufficient if trading were similar to producing widgets. However, in an environment that is constantly evolving, a successful trading process must also evaluate the current conditions and the particular opportunities available in that environment. Much like an entrepreneur, A winning trader must possess the ability to recognize and adapt to market changes. This skill is critical for achieving success. The evolution of markets affects both traders and investors who are actively involved. Market behavior can vary depending on the hour of the day due to differences in volume and participation, as well as the occurrence of various events and catalysts across time zones. Moreover, we cannot approach investing in the markets of the 70s the same way as we did in the 90s. The changing nature of markets demands a dynamic approach that adapts to the current conditions. Is it possible that certain market periods are not feasible for trading because they shift too quickly for us to adjust our strategies accordingly? One of the major causes of trading psychology problems is the practice of holding positions during market periods that are not stationary. A crucial aspect of achieving success in trading is being able to determine when to hold on to a position and when to let it go. Remember, knowing when to hold them and when to fold them is key. Thanks for watching. Give us a like if you appreciate this content. Subscribe, share, and comment below. Remember, don't worry, have fun trading.